This is not financial nor professional advice. This video is for entertainment only. Hey everyone, I'm Stephen Fox. Welcome to my channel. Today I'm going to be talking about why doesn't the stock market crash? It seems like it's been trying to for about the last year, and it's done it in a slow and torturous way, but it doesn't reach that final bottom where we can get a springboard upwards. I think the reason partly is because mega caps are being bought by people as fortresses of safety. People are flocking to these, thinking that they are going to hold out and they are going to go forward. And there's lots of positive news with the mega caps, which I'm going to go into. Be sure to watch this video all the way to the end, because I'm going to tell you a lot of good news that you don't hear that much. And I'll go over the other side too, to some degree, because we have to keep some money in cash in bonds and money markets to cover ourselves. But I think we're going to miss an opportunity, maybe, if these mega caps hold up, and they've been holding up awfully well. In fact, most of them have already had their crash, and so they're unlikely to go down that much more. Plus the factor that people are just clinging to them as the fortresses of safety, I think, is saving the day. I'm showing you this chart to give you an idea of what I'm talking about. Google, Apple, Microsoft, Tesla, and Amazon have all gone above 20% since the beginning of the year. And Tesla has made about 50%. So they are almost being treated like value stocks when things are so uncertain. Friday, the stock market wasn't open, but we received word on the employment numbers, and they were good. It reassured the stock market that recession is some time away, because when you have the unemployment rate drop from 3.6% down to 3.5%, there's never been a recession where there's been that low a level of unemployment. And so the U.S. futures on the stock market, they went up, and bonds went down. They slid, and they slid because when the interest rate is anticipated to go up, bonds go down. And it's likely that he's going to raise interest rates by 1/4 point when they meet. And of course, we got our daily dose of bad news with the International Monetary Fund warning that the next 5 years will have the slowest growth since 1990, and that it will be a big, severe blow to the world economy. So, we just get headline after headline like this. There is good news with the banking crisis. Jamie Dimon says that the banking crisis is getting resolved, that there's only a handful of banks that still have issues, and if failures happen, it will probably be the last of them. Maybe we have one or two more, and hopefully they're not major failures with the biggest of banks, but the smaller regional banks. So that seems to be clearing up. And I must say, I think the Federal Reserve has handled that in an excellent way with their discount window. And they started a bank term funding program. They are literally bailing the banks out. They're accepting the banks' bonds at their face value. They would not be worth face value until maturity otherwise. but the Federal Reserve is taking them on when they're reduced in value and giving the banks credit for the full value of their bonds, which have decreased in value, which is causing the crisis. And they decreased in value because the Fed raised the rates so fast that the bonds that the banks held all went down in value. And then depositors wanted their money back from the bank so they could put it in the money markets and get a good interest rate. So the bank was literally running out of money, and they got to cash in their bonds when that happens, and they're cashing it in at 70 or 80 cents on the dollar, which can cause some banks to go busted. Another paradoxical thing that we didn't expect is the Federal Reserve bailing out the banks has had a stimulative effect on the economy, I think. They reduced their balance sheet, but in the last month or so, they've put at least $300 billion into the banks to bail them out. And that tends to have a somewhat stimulative effect on the economy. Like I say, the Federal Reserve was put in the position of sort of stimulating the economy while they're raising interest rates, but they have to do that to prevent a liquidity crisis, which could bring the whole system down. This earnings season is set to kick off with the end of the first quarter. We're going to start getting some earnings reports, and Goldman Sachs warns that the profits of stocks are going to drop, and they worry that's going to be like what happened in 2020. So we think it's because their costs have increased, but also the Federal Reserve has reduced demand, at least somewhat so far. Not everything was sunshine and roses with the job numbers. There was a decrease in warehouse workers, but that could be seen as good news because maybe the warehouses are getting full and they have less need for workers. So hopefully the warehouses are getting full because of reduced demand, and they're going to get a glut of goods, and they're going to have to drop the prices on them, which will help inflation a lot. And I thought this was a insightful article in Barron's. Tech stocks have turned the corner while earnings could still spell trouble. And the article says the first quarter of 2023 was a remarkably profitable one for tech investors, helping to turn the corner on a nightmarish 2022. Stocks that were pummeled last year have rebounded with strong gains. The 7 tech companies with market values above $500 billion, Apple, Microsoft, Alphabet, Amazon, NVIDIA, Tesla, and Meta, have each rallied at least 20% in 2023, outstripping a 7% gain for the S&P 500. Investors think the Federal Reserve is nearly finished tightening monetary policy, and they anticipate steady and then declining rates. As a result, miserable first quarter results, and they almost certainly are going to be pretty bad, might not matter. The problem is the Fed, it's doubtful that they're going to even pause the rates, let alone cut them. As we look at this chart, this is from the Cleveland Federal Reserve, and they try to predict what inflation is going to be in the future. And for March and April, it's still in the 5s. That's a long way from their 2% goal. So I think the problem is that we're going to get lower earnings, and I don't think the Fed is going to pause. The other good news is that we keep getting reports of major developments with some of the mega caps like Google and Apple and always Tesla. That's why Tesla it always rebounds eventually. In this article, they're arguing that Google has been involved in artificial intelligence for years. This is not a new field for them, and they devote considerable effort to developing it. I think they're going to be adding Bard to their search engine to compete with Microsoft's Chat GPT. It's coming of age. It's coming of use. They have their hands in every area of the artificial intelligence field, and they have the size and the economics to drive artificial intelligence into a profitable part of their company. Right now, it isn't that much of a profit for their company. They make 78% of their revenue on advertising. So right now, it is an advertising company, but they've always been involved with artificial intelligence for years. And they're likely to make major breakthroughs if any company is going to. They have a PE valuation of 23, and that is cheap for a major technology company like this. This is a chart of Google's PE over the years since about 2014, and you can see that in 2018, it was over 60. So it's come down quite a bit. The market is acting like its advertising business is done, and their artificial intelligence isn't going to go anywhere, which is far from being the case. Recent reports show that Google has designed chips much better than NVIDIA's GPUs. Google recently released a report showcasing the strength of its TPU v4, a supercomputer made using Google's accelerators. One of the selling points is that this supercomputer is faster and more energy efficient than it would be if it were using NVIDIA's accelerators. So they're beating the top of the line company when it comes to computer graphics, and NVIDIA is considered the engine of artificial intelligence. I think Google might be taking over that role in the not too distant future. So Google is the first of two stocks that I will be buying because of the excellent news it got about having chips that can compete with NVIDIA's and are even better than NVIDIA's. Who would have thought such a thing was even possible? Looking at the chart, you can see that it's well above its 50-day average, and its relative strength is 69, which indicates that it's not overbought. And I think there's a lot left in this run, unless we get some black swan event, which I don't think is going to occur. I think the bank crisis is calming down, and I think we have a shot here at it going forward if we don't get horrible news from the Federal Reserve. I think they're going to increase it 1/4 of a point, which actually might be a point to buy more Google because the price will probably dip somewhat. But I don't expect it to dip much, simply because its price to earnings is so low for a major technology company. Another good reason I'm going to be buying Google is Warren Buffett has started buying Google sometime last year. And he considers it a major miss of his that he didn't start buying it sooner. My second stock that I'm going to buy is also a Warren Buffett stock. I was surprised to learn that he owns Super Microcomputer, which I've been pounding the table on for about the last year. Super Microcomputer has a PE of only 10. It's a computer maker that makes all kinds of computer equipment, especially servers, and its earnings growth rate is 41. So it's a very nice looking chart. You got that left to right upward movement, and it's dipped a little bit lately, which I think is an opportunity to buy it. And I was surprised to see that Warren Buffett also owned it, which encourages me even more. So Google and Super Microcomputer will be the stocks that I will be buying during these uncertain times. Of course, I'm going to keep a fair amount of cash in interest-bearing securities, money markets, and bonds. I don't think you can pass that up, especially when the news is so good and so bad at the same time. I've never seen it quite this disparate. So thanks for listening and watching. Be sure to subscribe if you haven't already done that. Smash that like button, and I will plan to see you in the next one. Thank you.